Chapter 3, do this and you won't pay tax on your Social Security benefits. In 1983 and again in 1993, provisions were made to the tax code to allow for the taxation of Social Security benefits. If your income was above a certain provision, some of your benefits were taxed. Thus, the term provisional income came to describe how much of your Social Security benefits are taxed. Oddly, go to SSA.gov or IRS.gov and type provisional income into the search button and see what you come up with. Nothing. Now, don't get me wrong. Both of these sites have tons of information on how benefits are taxed. Here's the IRS, for example. A quick way to find out if a taxpayer must pay taxes on their Social Security benefits: add 1/2 of the Social Security income to all other income, including tax-exempt interest, then compare that amount to the base amount for the filing status. If the total amount is more than the base amount, some of the benefits may be taxable. Base amounts. The 3 base amounts are $25,000 if taxpayers are single, head of household, qualifying widow or widower with a dependent child, or married found separately, and live apart from their spouse for all 2018. $32,000 if they're married filing jointly, and 0 if they're married filing separately and lived with their spouse at any time during the year. Whew, clear as mud, no? You get that? The complexity is why the vast majority of Americans have no clue how their Social Security benefits are taxed, to include most financial advisors. This is unfortunate given how many Americans rely so heavily on their Social Security in retirement. Understanding provisional income. Now, Kiplinger's magazine is a magazine I use all the time, a wonderful resource for lots of financial planning topics, but in particular, Social Security information. And they write, your provisional income is your adjusted gross income, AGI, not counting Social Security benefits plus non-taxable interest, and half of your Social Security benefits. Now, let's illustrate how this works. We'll bring back John and Judy. We'll say they have $100,000 of total income, but this time it consists of 45 in Social Security, 40 in pension, and 15 of tax-exempt interest. So 45 in Social Security, 40,000 of pension and IRA distributions, and 15,000 of tax-exempt interest. To calculate their provisional income, we simply add half of their Social Security benefit to all the other income that they have. And so half of the Social Security benefit is $22,500. Their pension and IRA income is $40,000. Their tax-exempt interest is $15,000. So their total provisional income is $77,500. Now, they're married, so we need to go to the IRS table and find out how much of their Social Security benefits will be taxable income. Remember, finding the provisional income does not say how much of the benefits will be taxable. That gives you the first number you need to go and figure out how much of your Social Security benefits are taxable. And so what we do is we say, okay, John and Judy are married filing jointly. The first $32,000 of provisional income. So remember, there's $77,500 in total provisional income. The first $32,000 is not subject to any taxation whatsoever. The next $12,000, 50% of that is used to calculate their taxable Social Security. So 0 to 32,000, nothing. 32,000 to 44,000 is 12,000, which is $6,000 because we use 50%. That's the breaker there. And then anything above the $44,000 threshold, in this case, it's $33,500. 85% of that is included to determine your taxable Social Security benefit. In this case, it's $28,475. So we take the $6,000, we take the $28,475, we add them together. Their taxable Social Security at this point is $34,475. And we find that 77% of their Social Security benefit will be subject to income tax. Now, this is confusing on the audio book. I get that. You got to understand, it's not a bad idea to actually read this verbatim with the visual aid, because I think it'll help you quite a bit, frankly. But remember, that's how the Social Security benefits are taxed with a provisional income. You've got to understand what provisional income is and how it's calculated. And I just want to reiterate this until I'm blue in the face. Provisional income is how much of your Social Security, determines how much of your Social Security will be subject to taxation, all right? And you take all of your income, all of it, to include tax-exempt interest. Yeah, I know you thought tax-exempt interest was tax-free. And then we add to that half of your Social Security benefits, and then they run it through this little chart of the provisional income base amount, like we just talked about, the 32,000, the 44,000, and so on. And that gives us your taxable Social Security benefit. So in this case, we need to calculate their taxable income for John and Judy. And what we do is we take their taxable Social Security, we take their IRA distributions. So their taxable Social Security was $30,475. Their IRA distributions is $40,000. That puts them as a adjusted gross income of $74,475. We subtract out their standard deductions of $26,600, and thus their taxable income is $47,875, which means they have a tax due of $5,364. That's a lot to go over on an audio. I get that, but remember, tax-exempt interest is included in your Social Security determination of how much you're going to pay on Social Security. Tax-exempt interest is not included in your total income tax. All right. So there's two things going on here that I think a lot of people overlook. They realize that tax-exempt interest is tax-exempt from income tax, but it's not tax-exempt from determining the amount of your Social Security benefit will be taxed. All right. So remember, we got tax due here for John and Judy, $5,364. Now, let's change things around a bit. Now, John and Judy, they still have $100,000 of income, but now it consists solely of Social Security and Roth IRA distributions. This is my favorite kind of retirement plan. So John's Social Security is $30,000. Judy's Social Security is $15,000. And they have $55,000 of Roth IRA distributions, which means their total income is $100,000. Want to guess what their income tax is? Think about it. Think about it. It's a big fat nothing. Goose egg. Why? Because going back to Kiplinger's, if you are married filing jointly and your provisional income is less than $32,000, you won't owe taxes on your benefits. In John and Judy's case, their provisional income is only $22,500. Roth IRAs are not included in provisional income, and half of their Social Security benefit is included. And their provisional income is $22,500 because their Social Security benefit was $45,000, which means their provisional income is less than the $32,000, means none of their Social Security benefits are taxed. And of course, Roth distributions are tax-free as well. $100,000 of income and not one penny in federal taxation. Not too shabby, if I do say so myself. That is the beauty of the Roth IRA, my friends. Don't forget it, please. Stay tuned, though. We got more to come, and it's going to be it's going to even get worse, too. And we'll go into the next on Chapter 4.